Good morning, everyone. Welcome to Navigating COVID-19 for Nonprofits. This is Carmelita Scott, President and CEO of the ATL Airport Chamber. Our experts this morning are Jeff Faceto and John Schultz from Malden & Jenkins, LLC. They'll be sharing valuable information that the nonprofit community can use. We ask that you mute your microphone and place all questions in the chat box for the Q&A session at the end of the presentation. The session is being recorded and we'll provide a link to all participants after the session. At this time, I'd like to turn it over to John Schultz from Malden & Jenkins.
Thank you, Carmelita. Jeff, do you want to put up the PowerPoint?
Okay. Good morning, everybody. Okay, I'll go ahead and start it off, and we're going to kind of move through a good bit of information fairly quickly, and like what was mentioned, if you have any questions, just put them in the Q&A box and we'll try to answer those. And we're going to focus initially on a couple of loan programs that I know at this point most everybody's heard of, maybe except for the Main Street Lending Program. So we have the Small Business Administration Economic Injury and Disaster Loan Program. So most people call that the EIDL program. And this program, like the PPP program, ran out of money. But as of Friday, with a new bill being signed, there's $60 billion now that has been added to this program. And the one thing to point out here, this is the program where initially you could apply and receive $10,000 that would be forgiven automatically. And since the beginning of the program, it has been changed now to where when you apply for the program, you can receive an advance of up to $1,000 per employee. And that $1,000 per employee up to $10,000 will be forgiven automatically. So that was a change. They were trying to cut down on the amount of money that was coming out of the program with people applying, just getting the $10,000 and not asking for any other loan out of that program. And then we've got the Paycheck Protection Program, and then we'll talk about in here in a minute, and then the Main Street Lending Program. Now, in the EIDL program, this is for businesses with 500 or fewer employees, average annual receipts of under $7.5 million. And one thing that we point out here is, yes, you can participate in this loan program and have a PPP loan. So the key is that the two don't duplicate each other, what you use the proceeds for. The amount under this program is up to $2 million. And the rate is 2.75 for nonprofits. And like I was just mentioning, can be forgiven up to $10,000, and it's $1,000 per employee. So like the PPP program, if you're thinking about borrowing funds, you would want to do this fairly quickly, and because there's a good chance these funds will run out like the PPP program. And on this loan, there's no personal guarantee for balances under $200,000, and anything over $200,000, there is a personal guarantee. This program is directly through the SBA, where the program we're going to talk about now, the PPP program, is not. That's going through your lender, and then the lender is working with the SBA. So that's one difference. And then you have to qualify for this loan, like you have to qualify for other loans. So it's not as automatic as the PPP program, but it's still, fairly automatic. PPP program. So beginning yesterday, banks and institutions started accepting applications again for this. I was reading this morning that there's so much volume happening again with this program that they're having trouble submitting applications through the SBA electronic filing system. And the SBA did something different this time around. They allowed banks to gather a number of applications and submit them all at one time, where before they were being submitted one at a time. So there's more volume, I think, because of that. And this program is a big deal because you can borrow up to $10 million under this program. The amount that you're eligible to borrow is primarily based on payroll cost. Those payroll costs that creates the eligibility, most institutions are using the 2019 payroll. So your January 2019 through December 2019 payroll. The payroll includes gross wages. It includes health insurance that the employer is paying. It includes pension that the employer is paying. And you add all those things together to come up with your payroll. If anybody's making over $100,000 a year, you have to limit that individual to $100,000. You take the total of those amounts, you divide it by 12, and you multiply it times 2.5, and that's your eligible loan amount. And if you haven't participated in this program previously, you would need to know that you would perform that calculation, gather your documentation to submit to the lender, and then there's an application that is online, and you can access it through the treasury.gov website. And it's a very brief 2-page application. And the primary requirement under this program is that you have economic uncertainty that is a result of the virus. So you might have heard on the news lately a lot of discussion about this, and some institutions that had gotten the money that they might have had other sources of funds where they didn't need to use this money to support their operations. And they've made a decision to since pay those monies back. And that was primarily happening with the public companies. So you just want to first make sure that you, as a nonprofit organization in particular, have made a determination that you have an economic need as a result of this virus. And the board has to actually adopt a board resolution to that effect, and you want to keep that documentation. And if you don't have a format for a board resolution already, you can go online and just Google example board resolution. You'll find a number of those out there. So we're recommending that all of our nonprofit clients do that so you can document the need for the loan. The rate is 1% for 2 years. Payments of principal and interest is deferred for the first 6 months. And the big thing about this that makes this program so popular is that the loans are forgivable if you meet certain criteria, and we're going to talk about that here in a minute. So the big thing is here, if you have not applied for this program yet, you need to literally be doing it today, because they're expecting these funds to have a burn rate of about $50 billion a day. So the first time that they came out with the funds for this program through the CARES Act, it took 13 days for the money to run out. And I read this morning, they're thinking this time around it could be more like 5 or 6 days until the money's gone. And it might even be sooner than that. So urgency is very important. Another thing, well, this screen kind of shows a timeline of how this has all evolved. So March 27th is when it all started, with the CARES Act being passed. April 3rd is when SBA started accepting PPP applications. And April 16th is when they announced $349 billion it's authorized for this program. April 24th is this new aid that they began accepting applications for yesterday. And then you can see here that it's talking about this average burn rate. And I think based on what I've read, it could even be faster than that. So urgency, once again, is very important if you're interested in these funds. John mentioned to me this morning that he read somewhere about a 5th round of stimulus that maybe would not occur until around the month of June. And it's always possible with another round of stimulus that they will continually add money to this program because it's very popular. And it's doing a lot to help businesses stay open or keep their employees. Now, we've got a screen here on how to find a participating lender, but one thing you might have read about is most lenders are not accepting applications unless you have a pre-existing banking relationship with them. And the reason for that is because of the volume of these applications, and they're having to kind of draw the line somewhere. So you would more likely than not need to go through your lending institution that you have a business lending or business relationship with. There's other institutions like credit unions and some other entities that will accept an application if you don't have an account with them, but primarily you want to start first with your existing banking relationship. Okay, this is kind of the big thing in regard to forgiveness. And we're going to do a separate webinar just on this topic once we get more guidance. So we have this guidance that you see on the screen now, and there's a lot of questions. So I'm on the phone every day with clients answering questions about the forgiveness features of this loan now. And when you really get down to the nitty-gritty, there's a lot of ways to interpret how this forgiveness is going to happen. So the main thing that you want to keep in mind at the moment, there's kind of there's three things that can catch up with you very quickly in regard to not having the balance that you've received on being forgiven. So remember, there's two things happening here. You're borrowing the money, and then if you meet certain criteria, you won't have to pay that money back. If you don't meet the criteria, the loan is a 2-year loan that is amortized after 6 months. So the very first thing you've got to pay attention to is this rule where at least 75% of the funds that you've received have to be spent on payroll. And the one thing I like to point out here is it's at least 75%. So let's say that, and then I'll just state that for the other 25%, that can only be spent on qualified expenditures, which include rent. We think the rent probably includes equipment and building rent at the moment, but we're not sure. They might just cut it off at real estate rent, but we don't know that yet. So for now, I'm telling my clients equipment and real estate rent. It would include utilities, which is electricity, gas, water, transportation, and most people are interpreting that as being fuel, internet access. So you've got utilities, rent, and then mortgage obligation interest. So let's say you add those three things up and over an 8-week period of time. So from the date that you receive your proceeds, you have 8 weeks to spend this money. And if you add up those three things that we just talked about, let's say they come out to 10%, then for your loan to be entirely forgiven in that circumstance, your payroll costs would have to be 90%, not just 75%. So another example, I know this is simple, but if you add up your interest, rent, and electricity, utilities, and it comes out to 20% over the 8-week period of time from the date you receive your funds, then you would need to spend 80%, on payroll cost in order for everything to be forgiven. And once again, payroll cost is your gross wages. It does not include the employer portion of payroll taxes. It's the employer portion of the pension benefit obligation that goes to the employee, and it's the employer portion of the health insurance that's paid for the employees. It's those things added up is what you're going to be allowed to use for payroll cost. So that's one thing you've got to keep your eye on, and you've got to keep these things separate, because now we're going to talk about the second thing that could potentially catch up with you, where it would cause a situation where you don't have everything forgiven. The second thing is that you have to maintain your employees at current levels of salary that is similar to what you had paid in the previous quarter. And let's see here. So and I'm going to talk about that in just a little bit more detail in a second. So in regard to this loan forgiveness, we're getting a lot of questions about documentation. We recommend that when you receive your PPP money, you put it in a separate bank account. And when you have a payroll, you move those funds from your separate bank account to your operating funds, and then disperse that money, for your payroll, as an example. And then as you go, you keep documentation, primarily being your payroll records, because we think that's what the banks are going to be using. And when you're paying your utility payments, do the same thing, move the money, then pay the utility payments, and keep the money segregated until you're actually using it, and then keep the documentation as you go, so that when you apply for forgiveness, after the 8-week period of time is up, you have all of your documentation ready to go, and it's not hard for the lender to process that application. There's a calculation that you've got to be careful about also in regard to FTEs. So first of all, like we were talking about before, they want you to spend at least 75% of how much you borrowed on payroll. That's the first thing. The next thing is they want you to not reduce the number of employees that you had, and they're allowing you to use a couple of base periods, and you take the lesser of the two. So you can either select a base period of 2/15/19 through 6/30/19, or you can select a base period of 1/1/20 to 2/29/20. Whichever one is less is the number of FTEs that you would calculate, and that's your base. And then you're going to compare that to your FTEs for the 8 weeks following when you receive the loan proceeds. And if you've got less FTEs than the base period, then whatever that percentage is that it's less, you would have to pay that amount of your loan back. The other thing that you've got to be careful about in regard to this forgiveness is if you have a reduction in salary of more than 25% on a per employee basis, then that's going to cause you to have to pay back some of your loan. And they're wanting you to use the most recent quarter that those employees worked and compare that to what you've paid them over this 8-week period of time, their average wages. And then once again, if it's more than a 25% reduction, it will trigger a portion of your loan which will not be forgiven. So those are the 3 things you've got to pay attention to. And we're going to get a lot more details about this in the near future. And one thing I'll just point out that's kind of a big picture thing, but maybe it's something you're thinking about already. At the moment, we think that the calculations in regard to that 75% calculation is going to be cash basis. So it's going to be whatever payroll you've actually paid for this period of time. Now, it might end up being accrual basis where it's just the payroll that you've incurred, but we're thinking that's going to be hard for banks to verify. And at the moment, most people are thinking that's going to be cash basis. So there's some ideas that you might have to accelerate a payroll to make sure you get enough, into your forgiveness calculation. Another thing to point out in regard to rent, most people are thinking rent is not going to be cash basis. It's going to be what you've actually incurred, so there won't be any way to pay your rent early or something like that. But once again, we don't really know the answers to those questions until we get more guidance from the SBA. And anything that you're wondering about these programs and certain very specific questions, if they've been answered, they are on the website that the Treasury maintains, and it's treasury.gov/policy issues, CARES, assistance for small businesses. And if you go to that website, there's frequently asked questions, and they date what date they updated that. So currently it's updated through April 26th of 2020. And there's a lot of information on the treasury.gov website regarding these programs, and you really want to go read all of that and make sure that you're up to date so you know what the conditions are of these loans. Okay, so John.
All right. Thanks, Jeff. Now we're going to talk about the Main Street Lending Program, and we just wanted to give a little history or on the context of the history of this program. When the CARES Act first came out back in late March, there was a reference to a program that was really to support what they're referring to as medium-sized enterprises, which they defined as 500 to 10,000 employees, which really would not be eligible for the small business enterprise, which includes nonprofits. But then the Federal Reserve came out on April 9th and gave some clarification or program description of the Main Street Lending Program, and they changed it to include small and medium-sized enterprises. So a key takeaway is you can have a business up to 10,000 employees and still be eligible for this program. We'll get more in the specifics, but we just wanted to talk a little bit about the details and how it flows. Comparing it to the P3 program, the main takeaway from this program is it is not forgivable, or does not have that forgivable feature, but it is very, it does offer bridge financing at very favorable terms at interest rates that we'll go into, and then payment terms. They actually give you a year to defer it, to pay it back, which is, again, is very attractive. They're doing it in actually 2 facilities. One is new loans, and then the second is actually, they're calling it expanding or existing term loans. So if you do not have a loan, you're eligible under the new loan program. It's a minimum of $1 million, so there is a minimum balance, and then a maximum of $25 million. And then for the existing term loans, they actually, so any loans that you already have, you can actually essentially refinance it up to $150 million. But again, there is a minimum of $1 million, so I think it will some of the very smaller organizations, it might not be an option for them, but again, it is open to any organization up to 10,000 employees is eligible. We did want to note, there is, when it first came out, the Federal Reserve opened up a week of Q&As, and it's very similar to when when the P3 program first came out. They did the same thing, where they had the initial description of the program. There was a lot of questions. They did a Q&A session, and really gave some more, gave some more guidance on that when it came out. And they actually did the same for the Main Street Lending Program. That actually closed on April 16th. And if you actually go to the Federal Reserve website, it actually has a note. The first thing when you see the program, it actually references that they have closed the Q&A section, session period. They're actually evaluating it, and basically we're in a waiting game to get the final comments and regulations of the program. So we're kind of in a holding pattern for the details, but as of now, not-for-profits are still eligible to be part of this program. There was some comments you might have saw on the news. Speaker Pelosi made a comment urging the Reserve to include nonprofits, where in the original description of the program they are already included, but which made kind of alluded to that there was talk that maybe nonprofits were not eligible for this, but as of now, and everything we're reading, they still are eligible. Under eligibility terms, we already talked about some of that. For any business, including nonprofits that have employees up to 10,000 employees, they're eligible for it. Revenues, there is has to be less than 2.5 billion in total annual revenues. So for the majority of our not-for-profit clientele, that won't be an issue. And then another key thing is that the majority of the operations of your organization have to be completed within the United States, and the majority of your employees are in the United States. The rates, interest rates, we already, I mentioned or alluded to it earlier, but they're very favorable. It's based on the SOFR, which is the Secured Overnight Financing Rate. It's just a daily indexing rate, very similar to LIBOR. Right now, it's actually 0.01%, so it's essentially a 0% interest rate plus the 250 and 400 basis points. So you're looking at a loan with an interest rate of 2.5% to 4%. And it is a 4-year loan. And the best part of this is they actually defer all payments for 1 year after you receive the loan proceeds. So 1 year deferral, and you can actually prepay it without a prepayment penalty. And then comparing it to the P3 loan, the one thing, or the one really shouldn't say negative, but one difference is that it's not forgivable. So this is a loan that has to be paid back. And then there are some certifications just like the P3. Like Jeff mentioned, we are recommending, especially for the nonprofits, that they have board resolutions to make those certifications. And one of them, the first one, is essentially you have to certify or test that your business or organization was negatively impacted by the COVID-19. And you're using the monies to make reasonable efforts to maintain payroll and retain employees during the term of the loan, the 4-year period. Another key issue is when the monies, you cannot actually use the money to pay existing debt or lines of credit if you already have it. There are some, it is more lenient in how to spend it compared to the P3. There's only, I think, like Jeff was mentioning, there's more restrictions on how to use the P3 monies. But, you know, as long as you attest that you're using the efforts to maintain payroll and retain employees during the term of the loan, you can really use the money for business operations, and it really serves as bridge financing for the organization. And the last thing, this is more for the for-profits, but there are some restrictions in the payroll on how it can be used. Stock repurchase and capital distribution restrictions are outlined, but it really doesn't impact the non-for-profits too much. That's all I have on it, Jeff.
Yeah, thanks, John. So on the PPP loan, one thing just to be clear about, when you borrowed the funds, it was based on payroll for 2019, like we were talking about, and then you've got these forgiveness provisions, you know, where if you don't use it for payroll or utilities or insurance, then you have to pay the remaining balance back. And for that remaining balance that you don't use for those forgivable purposes, you know, it just turns into like a regular loan that you can utilize those funds, you know, to support your business over the 2-year period of time, you know, as you're repaying it. Real quickly, outside of those loan programs, there's other things that you should consider. There's an employee retention credit. There's emergency sick leave and family leave provisions if you have that situation. There's a payroll tax deferral. I'm getting a lot of questions about this right now. And one thing I'll point out on the payroll tax deferral that's a little bit of a nuance. If you have received your PPP funds, your loan, up until the date that that loan is forgiven, you actually do qualify to defer your payroll taxes if you choose to do that. And if you choose to defer payroll taxes until that date, then half of those amounts that you've deferred are going to be due December 31st of 2021, and the other half are going to be due December 31st of 2022. So when you're making this decision, this is the employer portion of FICA and Medicare tax. But when you're making this decision, you have to consider the fact that it's really just a deferral. They're not giving you this money. You do owe it. You owe it in 2021 and 2022. So you have to think about cash flow. And if you really do need it now, I think that's a factor. But if you can get by without deferring this, it would just be one less amount of money that you owe in the future. So we're going to, these screens have got more information about the payroll tax deferral. And once again, it's just talking about the fact that it's the employer portion of the FICA and Medicare tax, and when it's repaid if you elect to do that. And then once your loan has been forgiven through the PPP program, you can't do this any longer. There's an employer retention credit, and you're eligible to receive a credit up to 50% of qualified wages up to $10,000. So it's a maximum credit of $5,000 per employee. And in order for you to qualify for this credit, there has to be over a 50% reduction in quarterly receipts. And so that's kind of a limiting factor here. And just something, you know, to consider, to know that this is out there. Paid leave provisions, just keep in mind that if you have somebody who is 18 years, it's younger than 18, then if they're having to stay home because school has been closed or a daycare provider is not open any longer and you're having to take care of that child, there's provisions where the employer can be reimbursed for that leave, you know, while up to 80 hours, you know, while the adult is staying home taking care of the child. And then there's family leave also that can be paid up to 12 weeks if you have an employee who actually gets the virus and is at home, and that is capped at $200 a day or $10,000 in aggregate. So in general, we don't have a ton of clients taking advantage of the emergency paid sick leave, because a more common strategy is to furlough the employee, and then the employee is eligible for unemployment, and then with the new unemployment benefits being $600, it's a federal benefit, and then the existing state benefit, it can get you up to about $900 a week. And oftentimes that can be more than what the paid leave would be under this emergency paid sick leave provision. So it's just something to consider. And it's unusual that we've got this $600 add-on that's coming from the federal government for unemployment. This screen's got more information about triggers in regard to paid leave. And it's just be aware, I think, for now, that if you have these situations, somebody staying at home with a child or somebody who actually gets sick with the virus, there's options, to be reimbursed, for a period of time. It's the main thing to remember. And John, I think you were going to cover this section.
Yeah, we'll just a couple additional tidbits to consider with the CARES Act. One is student loans assistance. They're allowing employers to make contributions up to $5,250. That would be tax-free to the employee to be used to be paid for their student loans. So if that's something you're considering, you might want to look into. Another is the plan distributions and withdrawals. Usually in retirement plans, there's a penalty for early withdrawals of the monies. Now they're actually relieving that up to $100,000, and they're actually doing the same for plan loans. So like a retirement or 401k, 403b loan, you can actually increase the loan amount from the plan up to $100,000. And then Jeff, do you mind going to the next slide? Yeah, and this is a big one. We and I'm sure everybody has heard this, but for the nonprofits, the organization's Form 990 tax return has actually been extended. So if your due date was between April 1st and July 15th, so we have a lot of clients that are June 30s of last year, where they might have already opted into the 6-month automatic extension, which would make their due date originally May 15th. Now it's actually getting pushed back to July 15th. And the same for our 12/31 year ends, where your original due date without the automatic extension would be May 15th. Now that's all. Now that's pushed back to July 15th as well. So that's a big key to consider with all this. Another thing is if you had significant estimated tax payments during the current year, we're recommending that you may have a refund, and you may want to file your Form 992 sooner to get that refund. And then there's a form to do that, is the Form 4466, and you want to do that by July 15, 2020. Another thing just to consider for the individuals, now they're actually offering a credit, or we call it the above the line charitable contribution deduction for those who file a standard deduction of up to $300 that individuals can take. And then those that actually itemize their personal taxes, there's a charitable contribution deduction. They actually increased it up to 100% of your AGI. So that is a big impact. So hopefully some of those dollars will, get to the organizations that need it. The next is actually corporations. It permits a deduction of 25% of charitable deductions of their taxable income, which is an increase. It used to be 10%. And then we are noting that contributions must be made in cash in 2020, and it has to be made directly to the public charity and the operating foundation, and you cannot be made through a supporting org or donor advised fund.
Lastly, just to point out, and this is something we've had to go over in some detail with some of our clients. There's affiliation rules that really haven't changed from some of the older SBA provisions. And if you have an organization that exercises a certain amount of ownership interest or control, and that control can just be actually management, then you have to consider those as a group and then compare that to the 500 people limit, on these PPP loans. And then also remember that, let's say you have over 500 employees and you think you still want to apply for the PPP loan, you can actually look at, there's an income limit in addition to the 500 people limit. And if you go to the SBA website, you can type in the type of entity that you are, and it will tell you an income limit where you might still qualify for the PPP loan even if you're over 500 employees. Now, in regard to the affiliation rule, there's certain entities that they are not applying this rule to, and one of those is faith-based organizations, primarily churches. So if you've got a church group, you can apply the 500 employee rule to each individual church versus as a group. And the same thing with restaurants, and the same thing with hotels. So they've excluded certain groups from these affiliation rules. And then for the people that it does apply to, if you just look at the specifics in regard to ownership, stock options and convertible securities that could be in existence. Common management is the one that gets a lot of people. Identity of interest is where you have some economic reliance between the entities, joint ventures, and a few other things. So you just want to pay attention to the fact that as a group you might not qualify where individually you would. So just to know that that's out there. This screen, has contact information for Carmelita, myself, and John, in case you have any questions. And feel free to email us or call us, and we're answering questions constantly. And I know that when you get into the nuts and bolts of this, it brings up a lot of questions. Okay. So, Carmelita, were you gonna kind of coordinate the Q&A?
I am. I don't see any questions in the chat box, however. We did get some questions before the session started. So if you do have questions, please put them in the chat box so we can answer them for you. Gentlemen, thank you so much for this valuable information. One of the things you mentioned was the affiliation rule, and that was something that we received earlier, and the question was around joint ventures. Can you expand on that piece?
So there's specifics in regard to the affiliation rules, and they've actually, once again, on the treasury.gov website, you'll see where they have program guidance for affiliation, and it says for borrowers, and if you click on applicable affiliation rules, there's specifics, and they get into details about affiliation based on ownership. So a joint venture is often common ownership, and it says that for determining affiliation based on equity ownership, a concern is an affiliate of an individual, an entity, or an entity that owns or has the power to control more than 50% of the concern's voting equity. So that's probably the shortest answer, that when you're looking at multiple entities, if you have one company that can control 50% of the voting interest of another company, that would be considered an affiliated group.
Thank you. And also, you referred to a link for the loan forgiveness. Can you put that in the chat box?
Let's see. So a link for the loan forgiveness. Yeah, I'm not really sure what they're referring to there. Now, what I was talking about is the treasury.gov website, that has almost all this information that we just discussed. And I could dump that into the chat box.
Yeah, and I actually just did, Jeff. I think
Okay.
we're referring to the frequently asked questions section of the Treasury, and I just put that out there.
Okay. Yeah, so like John just mentioned, when you access this link, it's the Department of Treasury website, go down to the for borrower section, and then you'll see in there just a lot of information. And the program rules down below that is frequently asked questions, and that's where they get into a lot of detail in regard to some of the things that have come up as we tried to apply these loan provisions. And it's updated fairly often. The big
Yeah.
thing that we're waiting on in regard to loan forgiveness has not happened yet. We are expecting significant guidance to answer some of the questions we have on loan forgiveness, and hopefully that comes out sooner versus later.
Gentlemen, is there a place where our callers can find an alternative financing list? There is a place to find a list of lenders, but is there one for the alternative lenders like the fintech?
They're probably, I'm not sure about that. I would think that, I know the government in this last round was really careful to want to encourage those alternative lenders. So they probably have come out with a list, but I haven't looked for it yet. Let me see.
I know, I read something. I know QuickBooks has a link, and then PayPal has a link as well. We could probably share if you.
Yeah, I'm not, at the moment, there probably is something like that online, and I have not looked for it yet. So we can look for that and see if we can put that out there for people's information purposes.
Okay, do we have any other questions for John and Jeff this morning? Don't be shy, we have the experts on the line. No, nothing else in the chat box? All right, well, if we don't have any other questions, I might mention that the session was recorded, and therefore later on today, early tomorrow, it'll be up on our website as well as on our YouTube channel. For those of you unfamiliar, our website is www.airportchamber.com. Also, if you'd like to continue getting information regarding all of the special webinars we've been doing in order to assist the small business and the nonprofit community through the COVID-19 pandemic, please make sure you're on our mailing list. As a nonprofit, you can join our chamber for $50 a year. And if you want to just be on our mailing list, then join as a chamber friend. But just to make sure that as we're getting updated information and pushing it out, that you're receiving that information too, you're welcome to do one, the other, or both. All right. So on that note, John and Jeff, thank you so much for speaking with us this morning. We really appreciate you taking time out of your busy schedule, and we look forward to working with you again in the near future.
All right, thank you.
All right, thanks.
Take care now.
Goodbye.
Bye-bye.